Welcome back. You're still watching Business Morning on Channels Television, and today on the program, our conversation is around the decisions reached by the Monetary Policy Committee after its two-day meeting held in Abuja. And I'm having this conversation with the Managing Director and Chief Executive Officer of Financial Derivatives Company Ltd, Mr. Bismark Rewane. He's still here with me in the studio. Thank you so much, Mr. Rewane, for sticking around.
Thank you.
Well, just before we went on that quick break to catch our breath, you were talking about the currency market. Now, let's still continue on that same line.
Yeah.
The Naira has been under pressure in the last couple of months.
Yeah.
We've seen a very strong buffering, trying to shore up the Naira by the Central Bank of Nigeria with the amount of dollars it's been selling. On Monday, it sold about 400 million. It offered 400 million, but so it's slightly less than that at its RDAS. Now, you also mentioned that there's been a widening gap at the interbank and at parallel market and, of course, on the official window. But for how long should the CBN continue to protect the Naira? For how long can it go on protecting the Naira? How should the CBN manage this pressure?
It's a fundamental question, not for how long, but at what cost. And, the reality is that what you're looking for is a exchange rate determining mechanism, not an exchange rate. The discourse in Nigeria is intellectually lazy in the sense that people say, what's the rate? Should be 165, should be 168? No. Before you finish announcing 168, that rate will change to 164 or something. It's a dynamic equilibrium. So what you want to say is that, what are the parameters that will determine the exchange rate? One, at what price of oil? Two, what production of oil? What import level? What interest rate differential, right? And what level of productivity growth are we going to have to come up with a composite set of parameters which will determine the exchange rate. Then after saying that, you now give a political risk discount to say, okay, Mr. President, the official rate says 175. No, the PPP says 175. But because we are in an election year, we'll give you a 10% discount. So let's do it at 170. But no, we can't do that. And that kind of discussion takes place behind the scene. But you come up with as close as possible to what is the fair value of a currency. The more distant you are from the fair value, the more distortions you have. And that's why would anybody have dollars at 155 and go and buy it at 172? The people are not mad. Why is that 25% of deposit liabilities in this country are in domiciliary balances where they are earning 1% when they could earn 10% on treasury bills? Everybody is betting. The most efficient economic agent is the individual. The individual is the best economist. The economists in classrooms are just laboratory economists. The real economists are the people who sell and buy things every day in the market. And the reality is that the currency, when a currency is overvalued, it's very simple. If you use the McDonald index, which means that the price of a hamburger, Big Mac in New York divided by the price of a Big Mac here, you'll find it's $5.30 the Super Mac, and it's 1,000 Naira here. It comes out about 266. You discount that for certain values and you come back to about 175, right? And then you take that and you come all the way down. But those are crude numerics. The reality is that a currency that is overvalued means the price of that good is too low, and therefore the demand is in excess of its supply. The only way to correct that is to increase the price. Increasing the price of a currency means you depreciate the currency. You make a currency adjustment. Once the price gets to a particular level, those who were buying it before will not be able to buy it anymore. The question is that, if you do that, will it create domestic inflation?
True.
No. The question is that, what has happened to the price of your imports? Take the price of rice. The price of rice has come down by over 25%. The price of the price of sugar has come down by almost 30%. The price of aluminum has come down by 40%. So if you take the total price of your imports, your import basket, you find that those prices have come down much more than the adjustment in currency. If we're talking about an adjustment in currency, we're talking about maybe 4-5%. Maybe you're going from 155 to 160 or 162. That it's an adjustment process to create some kind of equilibrium, because what you have now is an unsustainable gap between the demand and supply of foreign currency. The market has to adjust.
So definitely we're going to continue to see the CBN intervening in the market.
Yeah, but you can only intervene with what you have. You've gone all the way from 43 to 38.
37.
37. Now what are you going to do next? You've got to draw a line in the sand. So you need to make that thing more expensive.
Now, like one of my analyst Mr. Idohosa said yesterday that the CBN doesn't necessarily have to come out and say that we're doing a price adjustment or we're going to stop intervening in the market. But it really, something really has to give at some point, because we can't go on like this. It's making us more vulnerable than we already are, because we have external reserves that are dropping steadily every day, and we have the situation where the naira seems to be growing teeth and horns as it seems, and it's not making things any easy on Nigerians.
No, but the reality is that the economy is more than just the exchange rate. If you take the exchange rate of the South African rand has dropped by almost 14% or so year to date. The Indian rupee has dropped. The Indonesian currency has dropped. Even the Chinese currency has dropped. Brazilian currencies. So there's what we call the fragile five and all of that. The reality is that against our trading partners, against the dollar, the naira may depreciate. But against our trading partners, we are not going to see that much adjustment.
But are we better than any of our trading partners?
No, it's not that. Your terms of trade, your export prices have gone up by have come down by 3%, while your import prices have actually come down by point-something percent. So the terms of trade have moved against Nigeria. But the reality is that an adjustment is an adjustment. All countries adjust. So it's not peculiar to Nigeria. I don't know why there's so much difficulty. There's a difference between economic patriotism and economic reality. You know, that's why I'm saying that all of us are patriotic. I don't have to wear a green, white, green shirt to be here and carry the naira sign on. That's not the issue. The issue is that this currency, the price of the currency, affects everybody. If it depreciates, I'm not going to buy it at any other special price. The reality is that we have to make that adjustment. And if you don't make the adjustment in time, you'll make a bigger adjustment, and it's going to be more profound. The impact is going to be more profound. That's why I say, remember, it's like a gangrenous wound. If you don't want to amputate the toe, you will amputate the ankle. And if you don't do it in time, you will amputate the knee.
Or the whole leg.
Or there may be no patient.
Now, if you were to make a choice between low interest rate and a weak naira, and high interest rate and a strong naira, which side would it be? First
and foremost, let's take it this way. Our rate of inflation is 7.7%. Our prime rate is 12%. So our treasury rate is 11%. So there's a 4% headroom between inflation and the rates of interest. So there's enough room to come down. We have positive real interest rates. Ghana has 2.5% positive real interest rates. South Africa has about 0.5. We have 4% headroom to come down. So I don't think it's either or. We call it the holy trinity of economics in terms of inflation, interest rates, and exchange rate. You've got to combine these things. If you allow the exchange rate to depreciate a little bit, you will be able to allow your interest rates to come down somewhat, and then you can stimulate growth. Don't forget that fiscal policy is in charge of growth. So it's a combination of issues. Do I have it right? I'm not sure. But I think we can tinker with it. But there's no hard and fast rule. And don't forget, this pressure on the currency didn't start today. It started from October. So it has nothing to do with who is the central bank governor, who is not the central bank. This is Nigerian external imbalances, which has come upon us, and we have to deal with it. Every country, the US is doing its tapering and all that. It is not unusual. In fact, it is unusual to have a currency which has been stable for so long, right, in an unstable world. So let us accept that it is our responsibility as a country to accept that our currencies will be volatile and will be adjusted, but within a reasonable band. Okay, and that is what it is.
Yeah, you actually mentioned the fiscal aspect of it. So can the CBN really achieve much without a complementary fiscal policy?
Well, the Central Bank of Nigeria, or the Central Bank in any country, because of its autonomy, because of its independence, is supposed to be the counter-cyclical weight to reckless fiscal policy or excessive stimulus. So that's why you say you want to achieve accelerated growth within a framework of monetary stability. So the framework which they use for monetary stability is called inflation targeting. Okay. The anchor is called the interest rate. And the objective is to see and they've come up with a range of inflation of 6 to 9%. Okay? So the work has been done, basically. All we need to do is to manage the monetary policy to achieve the desired effect. And if your monetary policy is not synchronized with your fiscal policy, it becomes very clear what you are seeing today is, even though your inflation rate has come down, your unemployment rate has even increased. So when you add the two together to get a misery index, the number of Nigerians that are miserable are higher than those that were less miserable 2 quarters
So
ago.
at the end of the day, the policies that we have are not actually really looking like they're geared towards achieving the job creation and inclusive growth, which is what most of them have been talking about for the past couple
No,
of
you
months
see,
now.
there's numeric economics, which is what we're talking about, inflation and exchange rate. And then there's behavioral economics, which is about prosperity and happiness.
True.
One thing you cannot do, you cannot pretend to be happy if you are unhappy. Okay? Even if you pretend, it will become very clear. The reality is that, in the end, the numeric economics is to make behavioral economics positive,
Sure.
to make people happier. If they are unhappy, if they are hungry, there will be dysfunctional behavior. There will be kidnapping, there will be all sorts of things. So the first line of economic thinking is how to make the numbers, put them in equilibrium. The second line is how to make that translate into happiness and welfare. And the third line is to ensure that society, that it is stable. That's where we are. So the central bank is the one that we see every day. There are other things that are in play right now, petrol subsidy and all sorts of things. Those will come, but that will come after political expediency has been settled.
And of course, we're in a pre-election year, so
Yeah.
we're most likely to continue to see all of this play out until after the elections.
Yeah, the 5 most volatile currencies in the world today are the countries that have elections: South Africa, Turkey, Brazil, India, and one other one. So there is a correlation between currency volatility at times and closeness to electoral cycle.
Now, we know that today the Senate will be screening or screening the
Incoming governor.
incoming CBN governor and his deputy. What are your expectations? Because you see, he's actually going to come in and hit the ground running. There's so much already on ground for him to be attending to. What for you, what are going to be your own expectations as regards all these issues that we've mentioned? Should it be that once it comes in, the first port of call should be to look at the local currency, the exchange rate, and the rest of it? What, in your own opinion, should be his first, his top agenda when he comes in?
Well, first and foremost, the central bank is an institution, not an individual. Leadership is important. So I expect that as a leader, he is going to come in and take a look at what he finds on the ground to make some decisions. But in the end, the monetary policy there's a monetary policy committee, and by a simple majority, they voted yesterday 5-4 in terms of increasing the MPR. 5 said keep the MPR where it is, 4 said increase it to 13% per annum. So whether the governor goes in one direction or if you don't have the votes, you're not going to get. So the exchange rate band and all that are also subject to votes. So I don't think we should place too much emphasis on the role of the governor. While it's very important, because that's the leadership and that's the vision that is going to drive monetary policy. It's extremely important, but it's not the governor of the central bank is not a magician. He can only work with the assets and liabilities that he has.
True.
So I think that the work is cut out for the governor, the incoming governor, and the options are getting narrower. The options are getting narrower.
So now going forward, are we likely to see, for instance, a money supply crunch of any sort, or what's your advice? Okay, let's first of all look at going forward. Are we likely going to see any money supply crunch? Let's start with that one.
Money supply, annualized money supply is still negative instead of being positive, right? And that's why you are not seeing that inflation. But inflationary pressures are going to emerge again later on as the fiscal spending increases. I think that the emphasis, my first advice to the governor would be that emphasis should move from historical inflation to anticipated inflation. Historical inflation is what has happened. You're talking about inflation of February. That's gone. People worry more about expected price increases than prices that have increased. So if you hear today that the price of a handbag is going to go from 400 to 1,000, even if you didn't have the money, you'll borrow money to buy it before it goes to 1,000. So you're more worried about the future prices than the historical prices.
True.
So that fundamental shift in thinking to anticipated inflation rather than historical inflation is one. Secondly, whether we like it or not, the amount of invisible transactions that take place in Nigeria has increased relative to visible transactions. What I mean is that what we trade, what we bring in as imports, compared to what we pay for as services, the import level has reduced, and the services that we pay for have increased. That is the number of Nigerians who are going for medical tourism, the Nigerians who are going for education outside, Nigerians who are insuring their assets outside. So invisible items have become a major drain on economic activity in the country. Therefore, and the thing about invisible items, it is a function of confidence and certainty. Any policy that creates uncertainty and lack of confidence will immediately impact negatively on the visible trade of Nigeria. So one, first advice, look at anticipated inflation rather than historical inflation. Secondly, you have to lead by being visionary. And thirdly, your invisible items are becoming a major part of your external balances.
Well, just before we wrap up this conversation, Mr. Rewane, I forgot to mention it in the course of our conversation. They actually mentioned that the industrial sector has continued to lag behind, and obviously it's because of policies and the rest of it. But what's your take on this? Let me just quickly get that, and then let's wrap this conversation.
No, I think manufacturing is about 4% or 5% of our total GDP, but it's 69% of the market capitalization. So there's an exaggeration as to what the manufacturing industrial sector is contributing in terms of employment, in terms of its contribution and all of that. So we need to make some adjustments. The reality is that we're going to have a rebased economy any moment from now in the next 2 weeks or so, and it will show a much larger economy. But it will not show the structural shifts that are required to sustain this momentum. So our work is cut out for us in terms of what we can do. Monetary policy has a limit because it only addresses two things, the interest rate and the exchange rate. It doesn't address any other thing. The growth, stimulus, austerity, adjustments, and fiscal adjustments are all parts of the federal government, not the monetary policy authorities of the central bank.
Well, thank you so much, Mr. Rewane, for sharing your thoughts to us this morning on the program. It's been an interesting conversation.
Thank you.
Well, I've been speaking with the Managing Director and Chief Executive Officer of Financial Derivatives Company Ltd, Mr. Bismark Rewane, and we've been looking at the Monetary Policy Committee's decisions, which were reached yesterday. As we know, the committee decided to leave its monetary policy rate unchanged at 12%. It increased the cash reserve requirement on private sector deposits from 12 to 15%. But left the cash reserve requirement on public sector deposits at 75%. And from the conversation that we've had with Mr. Rewane this morning, it is imperative that something has to give at some point, because we continue to see the Naira under pressure. And at some point, the Naira should be depreciated to ensure that it does not totally lose value. But this conversation doesn't end this morning. Conversation will come again. And as just to remind you, the Senate will be screening, that is the Managing Director of Zenith Bank, Mr. Godwin Emefiele, for the position of Central Bank Governor, while Mr. Adebayo Adelabo will be seeking confirmation from the Senate for the position of Deputy Governor. That should happen today. We'll keep our eye on that story and we'll bring you developments as we get them. But that's the program for today. Thank you so much for watching. I'm Harriet Agbenyi.